Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Hurd, Senior Portfolio Manager at State Street Global Advisors, to discuss some tactical moves investors should consider for their portfolios. It's great to have you with us. Welcome to Trade Talks.
Thank you, Jill. Thanks for having me.
And what does a dollar bear market mean for investors?
Well, it means amidst all these miserable headlines globally, that the rest of the world for a U.S. investor looks a little brighter. So we do have, we think transitioning to a dollar bear market, which means that the dollar will go down and foreign currencies will go up. If you were to buy foreign bonds, foreign equities, then you have exposure to that currency. So as those currencies go up, then the returns to those foreign assets will have a tailwind behind them. So this makes foreign assets relatively more attractive, makes them brighter than they have been for the better part of a decade.
The U.S. dollar tends to move in 7 to 10 year cycles, and the latest bull market reached its 10th year in 2020 with a peak in March. So has COVID-19 accelerated a dollar bear market, and if so, how?
At first, quite the opposite. So at first we had the initial shock back in February and March, and the dollar, which tends to, as the reserve currency, be a safe haven, right? Deep liquid markets, people run to the U.S. dollar in order to protect themselves. After that, though, we started to see and think about the long-term impacts on U.S. growth. We saw the dramatic monetary easing from the Fed, which took rates effectively to the zero lower bound. And this very much accelerated or brought forward the turning point in the dollar cycle.
You note in your recent report that the prospect of increased U.S. regulations and taxes adds to the burden on the dollar. How so?
It's a matter of confidence and the outlook on the ability of the U.S. to grow and for U.S. company earnings. So our concern would be that with a Biden victory and a Democratic sweep of the Congress, that you would see tax policies that would shift income from corporates to households. Now, that's not bad, and it would also come with significant investments such as infrastructure, green investments, so very positive things, but it would be potentially downgrading to U.S. earnings outlook, and that could cause capital flows out of the U.S. In addition, you do have to think about potential inefficiencies and a drag on economic activity and potential growth that would result from higher regulation. And one of the reasons why the dollar bull market has really been sustained for so long is this idea of U.S. exceptionalism. U.S. assets have outperformed. That's because the U.S. economy has enjoyed a higher productivity growth level. This wouldn't eradicate that, but higher regulation would mute that effect and damage that U.S. advantage.
Well, we've learned that the Fed rates, they're going to remain near zero for at least another 2 to 2.5 years. How will that directly impact the dollar?
Yeah, well, after yesterday's meeting, I'm going to upgrade that to 3 to 3.5 years. In the first instance, it's very straightforward. The U.S. had yield. Most countries in the world did not have yield. People looking for yield simply bought U.S. assets, right? You could buy a 10-year at 225, 250, something that had an actual yield to it. But that caused inflows into the U.S., which means you have to buy dollars in order to buy those assets, and that helps support the dollar. And now we don't have the yield, so we would expect that impact to reverse. And the U.S. is no longer as attractive as a destination for foreign capital.
And that goes to my next point. You noted in your recent report that the U.S. dollar will not lose its reserve currency status. Can you expand on this further?
Yeah, well, this is the dollar doomsday scenario, and it comes up during every major dollar correction. 2017 to 2018, the euro rallied significantly, the dollar fell. There were many headlines about maybe in reserve managers switching over to the Chinese renminbi or another alternative reserve currency. So the dollar is the central currency. Most invoicing for trade happens in dollars. Some 60% of reserves, almost 2/3, are in dollars. Cross-border bank financing, debt, all about 2/3 in US dollars. That makes the dollar very, very central. If it were to lose that spot, implies a tremendous amount of selling of U.S. assets and the U.S. dollar. It's extremely bearish and could become disorderly. We don't think that that's going to happen because that dollar ecosystem, and it is best to think of it as an ecosystem, involves finance, banks, invoicing, so real trade that happens. It's extremely costly to replace that, and there's not a clear alternative. China is opening up and allowing foreign investors to invest in Chinese assets more. So the internationalization of the renminbi is happening, but still very slow. And so you still don't have a country that has the deep liquid markets, solid institutions, and independent central bank that can really support itself as as the predominant reserve currency globally.
Yeah, that's a great analogy that you had to think of it as an ecosystem. It certainly does make that point easier to understand. So what are the short-term tactical moves investors can take during a dollar bear market to protect their portfolios and take advantage of other potential opportunities?
Yes. I mean, as you said earlier, dollar bear market tends to be, and bull market, it runs in 7 to 10 year cycles. So this is inherently a longer term phenomenon, but it's very important tactically to do two things. One is we have to recognize that although the bear markets and bull markets last 7 to 10 years, a lot of the move happens in just 1.5 or 2 years during that time. And you don't want to miss that. So you have to start to prepare now over the short term you accumulate some exposure to foreign assets. At the same time, we're in a uniquely difficult position with the pandemic, and unfortunately, the number of global cases is ticking up again. So there's quite a lot of risk there. So short term, I would say, if you want to gain exposure to the dollar bear market, look for safer assets such as the yen, short dollar yen. The yen, like the US dollar, tends to do well in an equity market shock, as we're seeing today. Gold is maybe a bit stretched, but gold is another, not a currency, it's a commodity, but it in some ways functions as a currency, as a store of value. And it has some defensive qualities to it as well. So that may be a very good alternative over the short term. Longer term, you want to accumulate some of the higher beta or higher risk foreign markets, both to take advantage of the return and the recovery coming out of the pandemic, in addition to the dollar bear market.
All right, Alan, appreciate the insight. Thanks for joining us on Trade Talks.
Well, thank you.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.